I don't own gold because I think it might move from $2,042 to $2,150 or $2,200. I don't care at all about technical breakouts, $3 or $4 above the trailing average. I own gold and silver because I'm afraid of the deterioration of the purchasing power of my savings in US dollars. I'm afraid that the gold price is going to go to $6,000 or $7,000 or $8,000. Am I saying that's going to happen? No. But I am saying twice before in my life, gold has generated really, truly substantial gains.
Global gold prices have touched record highs this month, extending a year-end rally that could continue if the U.S. economy slows as expected, the World Gold Council said in a report. Sprott US Holdings Inc. CEO RickRule expresses deep concern about the decline in the U.S. dollar's purchasing power, foreseeing a potential gold price surge to $8,000. As the world's reserve currency, the U.S. dollar made up 58.4% of foreign reserves held by central banks in 2022, falling near 25-year lows. Emerging countries are slowly decoupling from the greenback, with foreign reserves shifting to currencies like the Chinese yuan. Meanwhile, he anticipates a significant comeback for precious metals, with a fourfold surge in related investment demand. Gold prices hit an all-time high Monday, buoyed by growing expectations of interest rate cuts among investors, a weaker dollar, and geopolitical tensions. Investors typically see the metal as a haven since it is a tangible, scarce asset that, in theory, holds its value. Gold prices have risen 10% so far this year. The price of silver has had a solid year so far. After dipping below $19 per troy ounce in late September 2022, silver started 2023 at $24, experiencing a 5% increase. Regarding portfolio insurance, Rule mentions historical gold bull markets, such as the 1970s and 2000 to 2011, showcasing the benefits of even a small allocation to precious metals. 1974, silver caught up with gold, surging 125% from late 1973 to the first quarter of 1974, signaling the end of the initial 1970s bull market phase. Over the next 2 years, both gold and silver fell 45%, while gold stocks collapsed by 70%. He points out the U.S. market's less than 0.5% share in precious metals, foreseeing a rebound to 2%, driving up demand for related investments. Now, we present the clips of RickRule's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think now that it's inevitable that precious metals will do well. I say it's inevitable for reasons that you and I have discussed ad nauseum over the last 3 years. Precious metals do well when people are concerned about the purchasing power of their savings denominated in fiat. And anybody who isn't concerned about the maintenance of their purchasing power is both illiterate and innumerate. With that long introduction, it staggers me that people aren't or more eager to invest in gold or silver. Previous gold bull markets have shown that a relatively small amount of insurance by way of gold or silver can generate large coverage, protecting your portfolio. In the decade of the 70s, the last time that we faced the recipe, the sort of menu of problems that we face today, the gold price went from an admittedly price-controlled $35 all the way to $850. A little bit of gold sheltered a lot of damage to the rest of your portfolio, probably more meaningfully. The last real gold bull market we had, 2000 to 2011, the gold price went from $256, I think, to $1,850. Pretty good move, sevenfold move, maybe more. The point of this, that people who don't have somewhere between 5 and 10% of their portfolio in precious metals are going into a circumstance with absolutely no portfolio insurance, with the need for real portfolio insurance. Beyond owning physical gold and silver, A as liquidity and B as insurance, people need to consider owning the gold and silver mining stocks. I'm going to argue that most people should own 3 or 4 of the great big ones, which is to say buy market beta. Because when the gold stock market moves, The biggest and best companies in the universe can give you 300 or 400% gains with very, very, very little company risk. For people who are dealing to do more work and take more risk, absolutely, positively, buy the juniors, a well-constructed group of juniors. I joke, Dunnigan, because all of the money now I invest prudently, I made by speculating wildly. I'm not saying don't speculate. I'm saying invest first. Own the beta before you seek the alpha. I think it's very important to do that. I have now been through 2 major bull markets in gold and 3 small bull markets in gold. In, as I say, the reference market that I have for the bullion, which is the decade of the 2000s, the gold price increased, as I say, from $253, $255 to $1,850 an ounce. A little bit of portfolio insurance salvaged your purchasing power from what could happen in other sectors. It's very difficult for me to understand why people wouldn't do this. I'm not suggesting that people put 100% of their net worth in penny silver stocks. That's not what I'm saying. Dunnigan, your listeners will be shocked to learn that the market share of precious metals and precious metal securities in the U.S. market is less than 0.5%, which is to say less than 0.5% of all savings and investment assets in the United States are precious metals related. The 4-decade mean market share of precious metals is 2%. I believe that at a minimum, precious metals will regain their 4-decade mean market share, which means that demand for precious metals related investments, gold, silver, gold stocks, silver stocks, that type of thing, demand for those will quadruple. That's precisely what I think is going to happen.
During the interview, RickRule dismissed worries about the Canadian government seizing gold and silver, highlighting their security outside the banking system while acknowledging challenges in the U.S. banking system. Still, he deems it one of the world's strongest. Canada's financial regulator said on Friday that it was maintaining the amount of capital the country's biggest lenders must hold, saying its previous actions had made the Big Six banks resilient. Recent banking crises in the U.S. have shown that a limited territorial banking network may not allow for an adequate fractioning of retail market deposits, thus exposing the intermediary to a bank run of large and uncovered depositors. Furthermore, he mentioned that gold historically preserved family fortunes, including his own, as a hedge against economic challenges. Let's get back to the interview.
You may recall, Dunnigan, your younger listeners won't, that we tried to fight the war on poverty and the war in Vietnam, guns and butter simultaneously. We lost both. And the consequence of that is that we ended up hopelessly indebted. The deterioration in the purchasing power of the U.S. dollar over the decade of the 70s, and by the way, the deterioration in bond markets and the equity markets were one for the record books. It was gold that saved many family fortunes, and gold, fortunately, that made my own fortune. Past isn't necessarily prologue. They say history doesn't repeat, but it certainly rhymes. I think the penalty that you have for looking at precious metals, if I'm wrong, is very low. And the reward which you will achieve, if I'm right, is very high. And I think that there is a probability rather than a possibility that I'm right. You don't need, frankly, to pay attention, social media, in the last 3 weeks. You need to pay attention to life experience in the last 70 years. Even in the decade of the 70s, when the writing was on the wall, ability for people to wrap their heads around the gold story didn't occur until the gold price had gone up 6-fold. The move from a price-controlled $35 to $200 was a stealth move. It didn't have people involved. And after, by the way, people began to get involved when the interest rate rose, the gold price fell from $200 an ounce to $100 an ounce, and it shook out many of the so-called faithful before going from $100 an ounce to $850 an ounce. So it's important that people pay attention not so much to the event of the last week or what they think might occur in the next 2 or 3 weeks, but rather pay attention to history. What matters is what happens over 3 years and 4 years and 5 years and 10 years. If you think that the Canadian government will march into the Royal Canadian Mint and steal all the gold and silver in Canada, do not own these vehicles. I don't believe that. I do own these vehicles, but they are certainly out of the banking system. They are beyond the touch of the FDIC. I don't personally believe that the government is going to come steal anybody's gold or silver. I don't believe that because, among other reasons, there's 400 million handguns in private circulation in the U.S. That strategy entails some risk. And government can steal from you in riskless ways, like inflation and taxation, excess government spending. That's very popular. Most Americans applaud the government when the government steals from them. It's only when the government proposes to steal overtly that things get nasty. So I think the probability that the government steals from you overtly is very, very, very low. The probability that the government continues to steal from you covertly is a 100% certainty. Further to the U.S. banking system, as shaky as it is ironically one of the strongest banking systems in the world. As challenged as the U.S. dollar is, Doug Casey would say it's the weakest currency in the world with the sole exception of every other one. We live in a truly strange place where a basket case like the U.S. dollar is a haven, liquidity and transparency. It is neither really liquid. Well, it is really liquid. I take that back. It is very, very, very liquid. To describe our system as transparent is probably not accurate, but compared to the rest of the world, it's extremely transparent. And it is very easy in the United States to find hyper solvent banks. It's incumbent on you, the depositor, to find those solvent banks. It's incumbent on you, too, not to be lazy. It's incumbent on you, if you have large amounts of cash on deposit, to split that cash among institutions. Not just among institutions that are FDIC insured, but rather among institutions that have enough equity in them that they won't need the FDIC insurance.
In its 2024 outlook, the Market Development Group for the world's gold industry outlined possible scenarios for the global economy in the year ahead. The most probable outcomes, either a soft economic landing or a recession, would support higher gold prices. Do you view gold as a substantial investment following the historical reliability of precious metals during economic uncertainties? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.